Okay, you guys, we're now going to go through exercise 2-2 on page 95 in your text. And then you'll have a similar one to work in the Connect Plus site. Actually, all your homework will be completed through Connect Plus this time. So the first exercise just wanted you to do the journal entries using the accounting equation. I thought we would just skip to making the journal entries in exercise 2-2, and then you'll have a similar one to complete, like I said, on the Connect Plus site. Alright, so let's look at the exercise 2-2. Says prepare journal entries to record each of the transactions listed in E2-1. So we'll just start. I'm going to put in just numbers for the dates. They don't give us dates on these, so instead I'll just put in number 1 for number 1, of course. Alright, issued 30,000 shares of common stock in exchange for $300,000 in cash. Okay, so you want to look for keywords. Well, we know our cash account increased. Cash is an asset, and assets increase on the debit side. So we now have $300,000 more in cash than we did before. Okay, we issued new shares of common stock. They don't tell us, sometimes in these transactions you'd have to deal with a par value on the common stock. Here we don't. They don't tell us anything about that. So we'll say there are now more shares of common stock outstanding. It's a stockholder's equity account, and they increase on the credit side. So we're going to credit common stock for the same amount. Now, if there was a par value assigned to the shares, we'd just credit common stock for the par value amount, and then credit another stockholder's equity account for the excess received over par. We'd call that paid in capital in excess of par common stock. But they don't use that account here, so I'm not going to either. On number 2, purchased equipment at a cost of $40,000. $10,000 cash was paid, and a note payable was signed for the balance owed. Okay. You want to look for keywords again. The first two I would go with would be purchased equipment. Well, that tells me we now have more equipment, which is an asset. We'll put the equipment on the books at its cost. It's an asset that increased by the amount of its cost. Assets increase on that debit side. Okay, what did we give up for the equipment? Well, we gave up $10,000 in cash. Cash is an asset, and of course they decrease on the credit side. Stuff's a little bit of review here still in chapter 2. We're probably going to get into a few things in this chapter maybe that are new for you, but the first chapter was kind of an oddball with just a lot of various topics about authoritative literature and things like that. But the second chapter is it's kind of a review of journal entries, or at least this problem is. Now, what do you see here? Well, our entry doesn't balance. So let's read a little further. So we paid $10,000 in cash, and a note payable was signed for the balance owed. That just means we borrowed the rest, right? Most people I know would say, well, I bought some equipment for $40,000. I paid $10,000 down, and I borrowed the rest. This is just a different way of saying that. Your book has it written in more technical terms. Notes payable, or we'll just go with note payable. That's a liability account. We now owe more notes than we did before this transaction. It's a liability then that increased by the amount borrowed. Well, how much did we borrow? The difference in these two, right? So the liability increased by $30,000. And now our entry balances. Okay, on number 3, purchased inventory on account at a cost of $90,000. The company uses a perpetual inventory system. That just means we'll increase inventory every time inventory is purchased, increase and decrease inventory every time inventory is sold. Under a periodic system, we would track purchases throughout the year. So what they're telling you here is you want to, on 3, increase the asset account inventory. Some businesses would label that as inventories. Your book goes with inventory here. I'm going to use that. So we would just debit the asset account inventory rather than purchases, since they use that perpetual system. And we're going to increase it. Remember, assets increase on the debit side, so we're going to increase the asset with the debit by the cost of the inventory itself. Now they say the inventory was purchased on account. Well, the account that represents what we owe creditors on account would be accounts payable. The liability that increased in this situation. And remember, they increase on the credit side. Okay, number 4, credit sales for the month totaled $120,000. Cost of goods sold was $70,000. Well, this one's going to require us to make 2 journal entries. One to record the sale at the sales price. Okay, and then one to record the reduction of inventory at cost. Okay, so let's take care of the sales entry first. How did we make those sales? Well, it says they were credit sales. The account that represents what customers owe us on account is accounts receivable. It's an asset that increased in this case. Customers now owe us more on account than they did before this month. Assets increase on the debit side. So we're going to debit accounts receivable for $120,000. All right. Revenue of the business also increased. And if the business is selling inventory, then the revenue account is going to be called sales. The revenue account that increased, remember, they increase on the credit side. And now also on number 4, we could have combined this into one entry. To me, it's a little easier, I think, if you separate it into 2, but a lot of businesses would combine it in one entry, and you certainly could as well. I'm just going to do a separate one for number 4. We'll know there's 2 entries because there's 2 amounts given in the transaction, the sales amount and the cost of the inventory that was sold. Well, if the inventory has been sold, its cost is no longer an asset, inventory. Its cost has now become an expense because all the benefit associated with it is in the past. So we're going to debit an expense account, cost of goods sold. It's an expense account that increased in this situation by $70,000. And they give you the name of the account there in the transaction. And our inventory asset account decreased here. We now have less inventory than we did when we started the month, which is the goal, of course. So we're going to credit inventory, an asset that decreased, for $70,000. Now you see how you could have combined those. You could have debited accounts receivable for $120, debited cost of goods sold for $70, then credited sales for $120 and credited inventory for $70, and made that all one journal entry if you'd wanted to. All right, and these are all transactions for March. They don't give us a date. They just number them off. But let's say on number 5, we paid $5,000 in rent on the warehouse building for the month of March. You guys, on March 1st, that's actually an asset for us, prepaid rent. But by the end of March, it would all become an expense when it's time to prepare an unadjusted trial balance and do the financial statements. So if we're only paying 1 month at a time, we'll go ahead and place it in the expense account. So we'll debit rent expense. It's an expense account that increased. And of course, if we paid it, cash decreased. It's an asset account that decreased. They decrease on the credit side. Okay, on number 6, paid $6,000 to an insurance company for fire and liability insurance for a 1-year period beginning April 1st, 2016. Okay, now here we paid our insurance ahead for a whole year. So we will create an asset there that's called prepaid insurance. We're going to increase its balance by $6,000. And we're going to credit cash, an asset that decreased by $6,000. Now, as time moves along, this asset, prepaid insurance, will become insurance expense as these months pass off. Okay, on 7, paid $70,000 on account for the merchandise purchased. And number 3, so let's go look back at number 3. We purchased some inventory on account, $90,000. We're going to pay those creditors $70,000 of the $90,000 that we owe them. Okay, so if we pay creditors part of what we owe them on account, we now owe less on account. So accounts payable is a liability that decreased by $70,000. Liabilities decrease on the debit side. And if we paid them, then cash of the business decreased. Cash is an asset, and of course they decrease on the credit side. Right, on the 8th, collected $55,000 from customers on account. Not the 8th, on transaction number 8, I guess. Okay, customers have paid us part of what they owe us on account. Well, that means we have more cash. It's an asset that increased by $55,000. If customers paid us part of what they owe us on account, then the asset account, accounts receivable, decreased. It's an asset, they decrease on the credit side. Alright, and then number 9, recorded depreciation expense of $1,000 for the month on the equipment. Okay, the debit here will be to the expense account, depreciation expense for $1,000. That's an expense that increased. And do you remember the credit from financial accounting? I hope you do. It's a credit to, and I'm sure you do, it's a credit to accumulated depreciation. Accumulated depreciation is a contra asset account, meaning it's going to be paired with an asset on the face of the balance sheet and reduce its balance. Assets increase on the debit side, as we know, so a contra asset would increase on the credit side. Okay, you guys, I think after working that one, you shouldn't have any trouble with the exercise 2-2 and Connect Plus. You probably knew how to do these already. I guess it's a bit of a review. Now, of course, these journal entries would be posted to the ledger accounts, and then from the balances we could prepare an unadjusted trial balance. But we're probably going to move along to some more journal entry problems. We went through the ledger and the unadjusted trial balance in a lot of detail in financial accounting. But anyway, if you have any questions, please contact me via email or call me anytime on my cell phone. That's 828-593-0459. Please feel free to use that number. If I minded you using it, I wouldn't give it to you. And good luck with these. Thanks.